Does the future look good for the housing market and the home prices? Hi, I'm Beata Bukowski with Fairway Independent Mortgage, coming to you with yet another episode of our weekly economic update. According to CoreLogic, which stands for the golden standard of home value appreciation, we have experienced 0.4% drop from November to December in home prices, yet the year-over-year number is still a positive 6.9% appreciation in comparison to December of 2021. The bottom line is that the chief economist for CoreLogic, Selma Hab, said that while home prices in December continued to fall from November, the rate of decline was a lot lower than seen in the summer and spring of last year, and it is only still adding up to a cumulative drop of about 3% since the highest seen last spring. This is a far cry from the 20% drops that the media have been predicting. As far as CoreLogic's report, there was also an additional report that came out, speaking of home values and predictions for the future. Zillow and Pulsonomics released their home price expectation survey in the fourth quarter of last year. The survey participants included 117 top U.S. economists who were asked their expectations for home price appreciation over the next 5 years. Listen closely. The number they came up with is 23.3% appreciation cumulatively. To quantify this, if you bought a home this year at $500,000 and held on to the home for 5 years, you would earn, in only appreciation alone, $115,000. Once again, $115,000 earned on a $500,000 home purchase. And when you take into consideration the return on investment, because you probably will not be buying this property for cash, or rather with a very small down payment, the return on your investment is going to be in the hundreds of percent. There was some tough talk and misunderstood talk from the Fed when Jerome Powell was talking to the Economic Club of Washington, D.C. He said, if we continue to get stronger labor market reports and higher inflationary numbers, we will continue pressuring hikes on the Fed fund rate. The Fed fund rate is a benchmark that was raised 8 times since March of last year and currently is at 4.75. The Fed fund rate is the overnight rate money is lent amongst financial institutions, and that rate directly affects the prime rate, which then steers and controls consumer lending, not mortgage lending. Bottom line is, the U.S. jobs report was a lot stronger than what anticipated, and we have to be on a close lookout to what these reports are going to be coming in the coming months. Finally, CEOs feel a recession is coming. Top 142 CEOs in the nation have participated in a survey asking them about economy of 2023. Overall, the index came in at 43 points. While this is above the 32 points seen in the last quarter of last year, it's still below 50, which means that there's more negative responses than positive. Bottom line, yes, CEOs are seeing recession on our horizon. That's all I had for you today. Beata Bukowski, Fairway Independent Mortgage.